Time now for top picks from Chris Blumas. He's been taking your questions all program long. Let's go to top pick number one, Artis REIT, ticker symbol AX.U on the TSX, one of the real estate investment trusts that trades here in Toronto. Chris?
Yeah, so Artis is a diversified REIT, Paul. So I don't think there's anything as unloved in the market as a diversified REIT right now. You know, if you look across that segment of the real estate space, valuations are very, very low. I think what makes this one unique is there's a catalyst for change, and they had a new management team and a new CEO come in place a little over a year ago. And, you know, what they were able to do in the first year in terms of value creation, it was quite strong. So I think in terms of, you know, the outlook for the future in terms of, you know, Artis growing its net asset value per share is quite strong. And if you look at the current multiple, it's about 9 times FFO, dividend yield right around 5%, you know, a very, very attractive valuation in today's market.
Okay, from the real estate sector, we'll move to the tech outsourcing sector, CGI Group, a big player in information technology consulting. Ticker symbol GIB.A. CGI is the company. Top pick number two.
Yeah, this is a very, very shareholder-friendly company. And in terms of, you know, their footprint, you know, they have a global opportunity set in terms of which they operate. And, you know, they're really, you know, as more and more companies you know, are digitizing and going more digital. You know, CGI is kind of front and center with their outsourcing and consulting services. So I think in terms of kind of the, you know, a company having kind of the wind at their backs, they definitely got that. In terms of their capital allocation, they're very, very strong in terms of their acquisitions and buybacks. The company doesn't pay a dividend, so isn't good for income-seeking investors. But in terms of the valuation, you know, very, very attractive valuation, about 16 times earnings and a free cash flow yield greater than 7%. So, you know, another defensive one in a tough market.
Okay, and finally, rounding out the top three top picks on this day, and we'll revisit with Chris over the next year or so to circle back to these picks. Walt Disney, ticker symbol DIS in New York.
Yeah, Paul, so this is one I alluded a little bit earlier in the program versus Netflix. You know, I really, really do like Disney. I mean, it's down huge over the last year, maybe down about 50%. You know, that whole, you know, everybody associated with streaming has gotten hit really hard. What's unique about Disney, you know, they have a more diversified business. So, you know, in terms of the original content that they generate, you know, the parks that they operate, and then the kind of consumer products that they sell, you know, they have a very, very unique business model. And it is a business model that does generate free cash flow. For the time being, you know, they're investing in their direct-to-consumer business, which has scaled very, very quickly. So I think, you know, longer term, this is a business that, you know, it will do quite well and grow longer term, but is a little bit more diversified than a Netflix. And if you look at kind of the PE multiple, and what it doesn't account for is that the direct consumer business is generating losses right now. So, you know, that PE multiple over the next few, the earnings over the next few years will grow quite significantly. And I think it trades at about, you know, a conservative 30 to 40% discount on a sum of the parts valuation.